Okay, right. So, cash flows, statement of cash flows. What I want to do here is sort of look at some of the conceptual issues because what will happen is when we come to do the questions, you already know this. I think I'm really just jogging your memories and just taking you back to sort of the first principles of what's really happening here, right? So I think the issue here, first of all, is to understand what we're trying to do. Cash flows, I think what I'll do is I'll take you to the question I will be using. I mean, ultimately, cash flows are telling, a statement of cash flow is really saying, fundamentally, tell us, this is 2009 and 2010, tell us the movement of cash from, in a way, we already have our answers. We just want to understand how we got there. How did we start off from this 9,700 here of cash to this overdrawn, I believe this is overdrawn in this account here. Um, So you have, where is it? Here we have this bank overdraft. How did we go from 9,300 to a bank overdraft of 6,200? So I actually know what the movement is. I know the movement is 9,300 plus 6,200, which is 15,500. So it's gone 15,000 negative. I just want to understand how did that happen? That's the point, really, isn't it? That's the point. And so, kind of coming back up to here, that's really saying, well, listen, I know that cash comes into the bank from three areas. Well, I have cash flows from operations. I have cash flows. So when I say operations, this is to do with actual trade. So if you like, from revenue and buying goods and paying suppliers, right? So revenue coming in from customers, money coming in um, um, from trade payable. Sorry, us paying trade our suppliers, trade payables paying our suppliers, and us buying inventory. Right. This is my trade, literally. And then I also have cash flows coming in from investing activities. So investing activities mean I'm buying assets and I'm selling assets. So they keep it quite simple in that you're not buying the assets on credit and then you're paying the payable. No, you're just buying the assets for cash or selling the assets. So you have money going out when you're buying the assets, or your money coming in when you're selling the assets. Or you have cash flow from financing. So financing is sort of saying I have money coming in from new share issues, loans, so money coming in from, you might be paying off. It might be typically, you definitely with new share issues you have money coming in. With loans you might have money coming in from loans. You might be paying off loans. You might be have money coming in from loans. You might be paying dividends, if you like. And so you have these scenarios here. Of potential, and these are your three sources of money, which is why great questions on what is the difference between profit and cash. It's a very strange question. It's really, the point is really that profit, money coming in from profit, is part of the money in from cash. So profit in itself is a component of full cash. Full cash is money coming in from three areas. Profit is just what's going on with operations, I mean, as well as other issues. But the point is that that's why profit can never be equal to cash, because profit is just this one area. So that's kind of the general broad picture. So we're always looking for the cash. So this just takes you back to double entry. Sorry, Graham. But the point with double entry is that if you do the double entry, you can always find what the cash issue is. I mean, it doesn't really matter what it is. If I said trade receivable, you buy goods for £10,000, you buy on credit for 10,000 revenue. Well, how do I know if I know what the carried down figure is, if the carried down figure is 3 grand, well, I know what happened was you must have received cash for 7. So this is an experiment in double entry bank where you kind of know what the opening figure is, you know what the closing figure is, and you're trying to work out what the cash amount is. It doesn't matter what the T account is. That's the experiment you're doing throughout this whole chapter. You're constantly drawing T accounts and trying to find what the cash element is, because that's what we need. It's the cash element we need. So that's the first point I think I want to bring out. So again, highlighting the fact that we're talking about cash flows, and we're just trying to isolate those cash figures. That's the key. That's the key point. So we need to T account again and settle down and work on the T accounting gradually. Okay, great. So what I'll do in this video is I will look at, I'll start by looking at cash flow from operations. So the standard So typically you can just look in the bank ordinarily and just see how much money has come in from customers and how much you've paid out. And that would be simple, how much you bought inventory for. But really, the interesting argument is that the standard. Well, I could do the same, and I do the same for these two. So I literally look in the bank for these guys. These are literally direct. When I say direct, I just look in the bank and see what's happened in terms of money coming in and cash flow from financing, and I add it that way. But for this one, cash flow from operations, the standard IAS 7 requires you to use what's referred to as the indirect method. And the indirect method says reconcile or find your cash flow from operations by reconciling or finding what the profit from operations were and then finding it that way. So going back to profit from operations and finding it that way. Okay, so let me explain really what the principle here is with this. Let me see, can I clean this one? Okay, great. Let me just kind of explain what's happening here. So I'm starting off with cash flow from operations, right? I will stop at 10 minutes, but just to do cash flow from operations, just the principle, and that's what I want to show you. Because once I show you the principle, we just know what we do. We just say, oh, profit from operations, add this, add this, add this, take away this. We just know. But in terms of just understanding what's happening, first of all, that's what this video is about. So let's take a normal business. A is equal to C. So you start a business with £1,000. You start a business with £1,000. Okay, great. And let's just say you buy some goods. This is important. So you buy some goods. You have £1,000 in the bank. And then you have, yes, your capital is £1,000. So this is just money in the bank. So you use say £300, you spend £300 out of the bank and you buy some goods, expenses, right? 300. And then you sell these goods, if you like, for 500. So, and the money comes straight back into the bank, right? So now your bank account has 1,000, if you like, 200 in it, doesn't it? Because you went down 300 and you went up 5. So you now have 1,200. So your bank account has gone from 1,000 to 1,200. And if I asked you what your profits were, you would say, oh, in your profits, I'll bring the E over here. So I minus E. So I'm 500 minus 300. So your profit is 200. So your bank account has gone from 1,000 to 1,200. And your profits have gone from nothing, because you had nothing at the beginning, to 200. So you see that you have an increase in your bank by 200, and you have your profits, which also increased by 200. So the truth is, by simply looking at the bank account, I can know what your profits increase was. Remember, I'm interested in the cash flow, or by looking at my profits, I can know what my cash flow was straight away, because this is all cash. These are cash businesses, straight up cash businesses. Let's do the first thing. Say, for example, you and I know that in accounting we have depreciation. And depreciation is an accrual expense, right? It is an expense. So because of the accruals principle, I put through the process of depreciation. Say, for example, depreciation is 50. So I would put through an expense of 50 and credit accumulated depreciation 50 with the asset or whatever. Let's just say I bought an asset. So I will put through an expense, of course, of 50 here, right? So I would have put through an additional expense. So my profits, of course, right, would have gone down by 50. Of course they would, yes, because I would have had an additional expense here of 50, right? And this would have gone down. So this would have gone down by 50, and my profits would be showing 150. So you can understand this is really about reconciliation. The standard says, well, I should be able to, right, go from here to here, because I know that on a cash basis, profits and cash are the same. If I didn't have any of these strange expenses happening, I can know what my cash movement would be just by looking at my profit. So literally, it says, listen, if you want to know what your cash for the year was, simply start off with your original, whatever your profits are. So your profits for the year are 150, and add back any depreciation you took out. So simply, if I started off with 150 and I add back any depreciation, I will come back to 200. And 200, of course, is exactly the same thing here as my change, which is why when we start off with cash flow from operations, if you remember the very first thing you do when you have cash flow from operations, if you're trying to calculate your cash flow from operations, when you have profit from operations, the very first thing you do is to add back depreciation. And that takes you, in effect, gets you closer to the cash flow from operations. which is why we always add depreciation back to profit from operation, because in effect, it's taking away that non-cash element and taking everything back to a normal cash movement, right? And that's about bang on 2 minutes, 10 minutes, sorry. So that's the very first thing we see, right? The very first conceptual point we have when we come to talking about cash flows. Because I'm just talking about cash flow from operations. I'll talk about the others and I'll talk about the other issues, but this is my cash flow from operations. Okay, awesome. Great stuff. See you in the next video.